Hello everybody, the Iran war is escalating. How do you hedge your portfolio to turn rising energy prices into profits? You need to get long exposure to energies. Actually, during our part 1 newsletter in June 2025, we've been putting out this trade idea in gasoline, the RB futures contract, based on a weekly chart pattern to go long. It triggered an entry, a signal, entry and stop. And as we've seen with this escalation of the war, this trade has really worked well. There were actually a couple of others, entry opportunities, even at a better price. Now, this recent war has cut right through our stop run levels, 1, 2, 3, 4, 5 stop run levels, and generated an exponential rise, making a 60% profit on this chart. Just imagine trading a leveraged product like a future, what it can do to your portfolio. It hedges you against rising energy prices and turns your portfolio nicely into profit. Now, this is a huge move. Is this a blow off top, or is this just a first leg into a multi-year rising trend? Actually, our super cycle trends tell us that this is not a one-off thing. This is a multi-year topic for the years and months to come. And it looks like energies have taken over from the metals, because we see this rotation principle from one asset class into another. Was this the first pattern we've seen? No. We actually seen a lot of bullishness even back here right after the corona pandemic in March 2020. We got another bullish signal, this time on a quarterly pattern, and there will be more patterns following. Now, the markets are fractal. We're not only looking at a weekly or quarterly chart, we're as well looking at lower time frames and other symbols. This is heating oil, another oil derivative. And on the 60-minute chart right now, we've got an S1 pattern, a gecko pattern that has just triggered. Now, this might develop into a loss, or it might go positive, and then it acts as a hedge for your portfolio. Do we always execute with the future? No, you don't have to. Once you get the entry signal from a futures chart, you can actually execute either with the future or an ETF, or you can use a call option on an ETF or even a future, or you can use any other leverage derivative. This is your decision and really depends on the portfolio you want to hedge. For example, I've been using all of those for different portfolios I'm trading. Let's have a look here at crude oil, the CL contract on a 240-minute chart. We've got a combined S1 and S2 pattern here on the 240. A little bit more risky because we are just ahead of the very important psychological number 100, and the entry basically comes at the rebreak of the green line, or you wait for the 100 to be broken, and the system 2 signal is the rebreak of the last dominant high up here, which is a bit more conservative. Now, how far could this go? This is actually just a first leg here, and we can see it nicely with crude oil. The patterns project out our target to 200, which is basically coming to the high. It was just before the great financial crisis hit the market, and for the next couple of years, our target is actually 250 per barrel and higher. So as you can see, this huge increase is just an initial move. And there should be much more legs higher till the super cycle trends end. So act accordingly and hedge against energies.